Is Omnicom a buy or a sell? Let's get started with the model. This is a large cap company, 17 billion market cap. They're trading at $86 a share, and they have 197 million shares outstanding. Omnicom is a marketing agency. It was incorporated in 1944 and based in New York City. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. In 2021, their free cash flow was $1.3 billion. Then it went down 34% to $848 million in 2022. Up 58% to $1.3 billion in 2023. It's up another 12% to $1.5 billion in the trailing 12 months. And their margins are up to 10%. So that means they convert 10% of their revenue into free cash flow. Net income is a profit or loss on the income statement. It's revenue minus expenses. And that's really consistent between 1.3 and 1.4 billion every year. Margins about 9 or 10%. Revenue is a sales for the company, and that was flat from 21 to 23, but it's up a little bit in the trailing 12 months to 15.4 billion. They do pay a nice dividend, 3.25%, and that dividend cost them $551 million. The way you calculate that, it's 3.24% times the market cap, 17 billion. And their free cash flow is 1.5 billion, so they can cover the dividend almost 3 times, actually 2.7 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 26 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $23 billion. We divide that by 197 million shares. And we get a calculated stock price of 119. They're trading at 86, so they're trading at a 27% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 18 companies in the same industry as Omnicom, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a decent amount in CapEx, 108 million. Interpublic spends the most, 159 million. They have one of the higher debt-to-equity ratios, 2.0. For each dollar of equity, $2 of debt. They pay a nice dividend. They're one of only 5 companies that pays a dividend in this industry. They generate a lot of free cash flow, most on this list, 1.5 billion. They're also the largest company on this list, 17 billion. Pretty far ahead of WPP. They're trading at 4.4 times book value. The way you calculate price to book, it's stock price over book value per share. The best PE on this list, 12. They're trading at 12 times earnings. They also have an attractive price to free cash flow, 11. That's stock price over free cash flow per share. Their price of sales is equal to the median at 1.1. They generate the most revenue, 15 billion. They're not growing much anymore. Their 5-year annual revenue growth rate is only 1%. Magnet is number 1 at 35%. They're trading pretty close to their 52-week low, only 6% above the 52-week low. They're at 86.49 currently. And they're trading 17% their 52-week high. So it may be a good time to buy the stock. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $15,500 today, a 4.5% annual return. To summarize, I have them trading at a 27% discount, ranking 5 out of 10. I don't usually buy advertising agency stocks, so short term it's 4 out of 10, long term 3 out of 10, because it seems pretty close to its 52-week low. They do have really impressive ratios, 8 out of 10, really nice PE, a lot better than the median. Financials are okay, 6 out of 10. Free cash flow is up and revenue is up, but both are up modestly, not that much, especially with rampant inflation the past few years. Let's go through their income statement. Here's the third quarter of 2023, revenue 3.6 billion. In the third quarter of 2024, it's 3.9 billion. Let's see if they give a breakdown of the revenue. So about half their revenue is advertising and media, 2.1 billion. Precision marketing, 460 million, that's 12%. PR, 414 million, 11%. Healthcare, 338 million, 9%. Branding and retail commerce, 200 million, that's 5%. Experiential, 177 million, 5%. Execution and support, 209 million, 5%. Revenue is up in every category except 2, healthcare and branding. Branding is down the most. It was 212 million last year, now it's 199 million. Precision marketing includes personalized email campaigns targeted social media advertising, dynamic website content, location-based promotions, and recommendation engines. Here's a breakdown of their revenue by location. Of the $3.9 billion, $2.2 billion is in North America, $100 million in Latin America. Then you have $1.1 billion in Europe, $63 million in Middle East and Africa, $480 million in APAC. When you compare it to the third quarter of 2023, it's up in every region. It's up the most in Middle East and Africa, up 25%. In dollar terms, it's up the most in North America, $171 million. It was a little under $2 billion last year. Now it's $2.15 billion. They give a little more information on the revenue growth. Their PR revenue increased from spending on the upcoming US election. Their experiential revenue benefited from the Summer Olympics. The organic growth was partially offset by the underperformance in their branding and retail commerce. Their acquisition revenue increased $74 million or 2.1%. That was because they purchased the company Flywheel Digital in January of this year. The revenue from Flywheel was included in precision marketing. Here's Flywheel's website. They have over 2,000 employees. They're in 20 countries. Here's an article about the acquisition. They paid $835 million for Flywheel. This article is from October 2023. Flywheel enables companies to sell more goods more efficiently across hundreds of digital marketplaces, such as Amazon, Walmart, and Baba. So they have some pretty big customers. They work with over 4,500 brands. They've been around since 2014. They have an advanced technology platform called Flywheel Commerce Cloud. Omnicom CEO said e-commerce sales worldwide are going to increase by 50%, reaching $7 trillion by 2025. Most of the sales are in e-commerce, not in brick and mortar. Brick and mortar used to be everything. Now e-commerce is taking over. So the acquisition of Flywheel helps this company boost their e-commerce footprint. Let's go back to the income statement. Below revenue is payroll, $2.8 billion. Then rent and other costs, $325 million. So their cost of revenue is $3.1 billion. SG&A, $100 million. Depreciation, $61 million. So their operating expenses are $3.3 billion. Operating income, $600 million, which is higher than last year, $560 million. Their operating margin is down. Last year was 15.7%. Now it's 15.5%. They spent $66 million of interest on their debt. Last year, $54 million. They received $26 million of interest income. That's interest they received on their investments. So their pre-tax income, $559 million. Taxes, $150 million. Net income, $409 million. Their net income is $386 million. Last year was $371 million. The way you calculate earnings per share, it's net income over shares outstanding. Their EPS $1.97. Last year was $1.88. Their net income increased from last year, and their shares outstanding decreased. That's a good formula. It decreased about 2.5 million. So that's why their EPS is higher. Let's look at their balance sheet. Current assets $15 billion. Current liabilities $15 billion. So their current ratio is slightly below 1. $3.5 billion of cash. When we look at their statement of cash flows in a little bit, we'll see this $3.5 billion. I'll show you right here on the statement of cash flows. That's the cash at the end of the accounting period. As of 9/30/2024, that's their cash. In the beginning of the accounting period, it's $4.4 billion, which is their cash as of 12/31/2023, $4.4 billion. In the first 9 months of 2024, they spent $900 million of cash. 4.4 billion minus 3.5 billion, that's around 900 million. The cash decrease for the first 9 months of 2024 is 898 million, which is 4.4 minus 3.5. Let's go back to the balance sheet. Accounts receivables, 8.6 billion. This is how much money other companies owe them when they sell on credit. Then you have work in process, 1.9 billion. These are campaigns they're working on for their clients, but they're not complete yet. When they are complete, the clients will pay them cash, or they'll extend credit and their accounts receivables will go up. Here's a breakdown of the 1.9 billion. Media and production cost, 880 million. Unbilled fees, 1 billion. And then you have other current assets, 1.1 billion. Their total assets, 29 billion. Their biggest asset by far is goodwill, 11 billion. Their goodwill as of January 1st was 10 billion. They spent $750 million on acquisitions, and then there was $76 million of foreign currency translation. Let's look at their liabilities. $11 billion of accounts payable. This is how much money they owe when they buy on credit. Customer advances, $1.3 billion. Customer advances is tied to work in process. You can see it's right below it. Contract balances include work in process and customer advances that consist of advanced billings to customers. They have $6.2 billion of long-term debt. This is debt owed beyond 12 months. Here's a breakdown of the long-term debt. $750 million due this year at 3.65% interest. $1.4 billion due in 2 years at 3.6%. They also have debt in euros, 500 million euros. This is the lowest interest, 1.4%, 500 million euros. Assets minus liabilities equals equity, $4 billion of equity. They raised $415 million from selling their business, selling stock. They profited $11 billion from running their business. Retained earnings is a sum of all their prior net incomes minus the sum of the dividends they paid out. Treasury stock is a contra equity account. It's when they buy back stock. It brings down your equity balance. They bought back $6.4 billion. At the beginning of the accounting period, they had $6.37 billion of treasury stock. They issued $62 million of stock to their employees, stock-based compensation. They bought back $113 million of stock. So that's how they got from $6.37 billion to $6.42 billion. This report is known as the Consolidated Statement of Equity. After the three main statements, balance sheet, income statement, and statement of cash flows, this is the most popular. Let's look at a statement of cash flows. The first section is operating cash flow, and they have negative cash flow. That's not good. Negative $200 million. Last year was negative $379 million. They did have a profit of $1.1 billion, but they spent $1.6 billion running their business. Here's a breakdown of the $1.6 billion. They had a cash inflow of $380 million from accounts receivables. This means they extended credit in the past and are getting paid in this accounting period. The biggest cash outflow is accounts payable, $900 million. This means they bought on credit in the past and are paying for it this accounting period. In their investing section, they had a cash outflow of $94 million from CapEx, a cash outflow of $900 million from acquisitions. Most of that $900 million was from Flywheel Digital, $845 million. They probably acquire lots of companies, so they're not going to list every single one, just the big ones. In their financing section, they had a cash inflow of $1.2 billion from adding debt. They paid $416 million in dividends. They bought back $360 million of stock. Last year, they bought back $560 million. These numbers are for the first 3 quarters of 2024. This column is the first 3 quarters of 2023. So for the first 9 months of 2024, they had a cash outflow of $900 million from running their business. That includes everything, not just running their day-to-day business. CFO is their day-to-day business, but they also invest in their business through CapEx and acquisitions, and they also fund their business through debt and equity. Let's look at a company on Simply Wall Street. Its last price, 86, 17 billion market cap, down a little bit in the past week, down 1.5% in the past year. Here's the stock price since 1990. It looks like it IPO'd below $3. This is stock split adjusted. After 9 years, it grew about 15x to $52. That was in 1999. And if you bought it then at 52, 13 years later, you're still at 52. 7 years after that, you're still at 52. Of course, there were ups and downs in between, but that would have been a nightmare if you sat on it for 21 years and had no upside. It did more than double since the COVID bottom, from 50 to over 100. It peaked at 105, and that was real recently in the beginning of December. It is down about 15% from that peak, so it's currently trading in the mid-80s. Simply Wall Street's valuation is 207. They say the stock is 58% undervalued. 11 analysts priced this stock at 116. They also say it's undervalued. Their revenue since 2014 has not moved. It was $15 billion then, and it's $15 billion now. I wonder why there's no revenue growth. Let me know in the comments if you know. They consistently pay a quarterly dividend. It looks like they raise it each year. It was 50 cents in 2015. Now it's 70 cents. The highest yield was 4.8% in 2020, and the forecast for 2027 is 3.6%. The CO salary was $1 million in 2018, down to $450,000 in 2020, back to $1 million currently. Total compensation $20 million, 10-year CEO, 28 years. In the past year, only insider selling, no insider buys. 99% of the companies owned by institutions, 1% by insiders. And the biggest shareholder is Vanguard at 12%, then BlackRock. Boston Partners, 2.2%. Hartford Funds, 1.5%. Goldman, 1%. And Eaton Vance at the bottom of the list. Their employee count was 74,000 in 2014. Now it's 76,000. So they're pretty much flat on employee count, similar to revenue. And the ticker trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, and Sao Paulo Bolsa. If you want a copy of my discounted cash flow model, click on the video in the top right corner.